The year is 2001, Buenos Aires, Argentina. Maria Fernandez wakes up at 5 inches the morning, earlier than usual, because something feels wrong. She has felt it building for weeks, a low hum of dread underneath the ordinary sounds of her life. She gets dressed in the dark, careful not to wake her husband, and walks 6 blocks to the branch of her local bank. She is not alone. By the time she arrives, the line already stretches around the corner and halfway down the next street. Hundreds of people, faces tight with the specific anxiety of someone who suspects they are already too late. Some have brought folding chairs, some have brought their children, wrapped in coats against the early morning cold. All of them are carrying the same silent question. Is our money still there? The answer, when it comes, is delivered not by a bank teller, but by a handwritten sign taped to the glass door. The bank is closed, withdrawals are suspended. The government has frozen every account in the country. In a single morning, the savings of an entire nation became inaccessible. Maria stands at the door for a long moment, reading the sign 3 times. Then she turns around and walks home, and something inside her, something that had been there her entire life without her ever noticing it, quietly disappears. It is the thing that economists call trust. And once it is gone, it is very difficult to bring back. To understand what happened to Maria, and to understand why it matters far beyond Argentina, we need to start with something most people never question. The modern banking system does not work the way most people imagine. When you deposit money into a bank, you are not placing it into a secure vault where it waits patiently for your return. You are making a loan to the bank. The bank takes your deposit, records it as a liability on its balance sheet, and then lends most of it out to other customers. This practice is called fractional reserve banking, and it is the foundation upon which the entire global financial system is built. At any given moment, the amount of physical cash a bank holds in reserve is only a fraction of the total deposits it owes its customers. In most modern banking systems, this fraction is remarkably small. The bank is, in a very precise technical sense, relying on the assumption that not everyone will ask for their money back at the same time. This assumption works almost all of the time. Most people leave their deposits untouched for months, for years, for decades. The system functions smoothly because it is built not on gold, not on physical reserves, but on confidence, on trust. But trust is not a commodity with a stable price. Trust is a social phenomenon. It can be earned over generations and destroyed in a single afternoon. To understand how trust breaks, we must first understand how it is built, because trust in financial systems is rarely constructed deliberately. It accumulates slowly, almost invisibly, through decades of ordinary transactions. For most of the 20th century, the citizens of Western democracies developed a deep and largely unconscious faith in the banking system. Banks were solid buildings, often built from stone, with thick vaults and professional staff. They were regulated by governments, insured by state agencies, and backed by central banks that seemed to stand as permanent guarantors of financial stability. This confidence was not irrational. The systems that had been built after the catastrophe of the Great Depression were genuinely more stable than what came before them. The Federal Deposit Insurance Corporation in the United States, created in 1933, meant that small depositors would not lose their savings if a bank failed. Similar deposit insurance schemes were eventually adopted across Europe, in Canada, in Japan, in Australia. The message was clear and deliberate. The government stands behind your deposits. In the decades following World War II, this institutional architecture produced an era of remarkable banking stability. Economic data from this period suggests that systemic bank failures became genuinely rare in developed economies. Credit expanded, home ownership rose, the middle class grew. People borrowed with confidence because they saved with confidence, and they saved with confidence because they trusted the institutions holding their money. The system, for a long time, appeared to work exactly as advertised. But underneath this period of stability, something was quietly changing. Beginning in the 1970s and accelerating sharply through the 1980s and 1990s, financial deregulation began to alter the fundamental structure of the banking system. Restrictions on what banks could do with deposits were progressively loosened. The barriers between commercial banking and investment banking, barriers that had been erected specifically because of the lessons of the Great Depression, were weakened and eventually, in many jurisdictions, removed entirely. Banks began to grow in ways that created a new and poorly understood problem. They became interconnected, not just with each other, but with insurance companies, hedge funds, pension funds, money market funds, and a vast and complex web of financial instruments that had not existed a generation earlier. The vocabulary of modern finance expanded to accommodate this complexity. Collateralized debt obligations, credit default swaps, structured investment vehicles, off-balance sheet entities. Most people had no idea what these things were. Most regulators understood them only partially. Some of the people creating and selling them did not fully understand them either. This interconnection created something that economists call systemic risk. In a connected system, the failure of one institution can trigger the failure of others, not because of any particular weakness in those institutions, but simply because of their exposure to the first failure. The risk is not contained within the failing institution. It spreads invisibly and rapidly through the connections between institutions. The system had become, in a technical but deeply important sense, too interconnected to fail safely, and it had become too large for the safety nets built in the post-depression era to fully cover. Historical records show that the warnings about this structural transformation were made clearly and repeatedly by economists and financial analysts across several decades. Those warnings were largely unheeded. The history of banking crises is, in many ways, a history of trust destroyed. The bank runs of the early 1930s remain the most studied example in economic history. Between 1930 and 1933, nearly 10,000 banks in the United States suspended operations. Historical records show that in many cases, these were not inherently insolvent institutions. They were institutions that experienced sudden, massive withdrawals of deposits by customers who feared, often based on rumors rather than facts, that the bank was about to fail. The fear itself caused the failure. Economists call this a self-fulfilling prophecy. When enough people believe a bank is going to fail, their collective withdrawal of funds makes the failure inevitable, regardless of the bank's underlying condition. The Argentine crisis of 2001, which opened this documentary, was a different kind of crisis but produced the same fundamental dynamic. Economic data from that period indicates that Argentina had accumulated unsustainable levels of sovereign debt, had maintained a currency pegged to the US dollar at a rate that made its exports uncompetitive, and had experienced years of economic contraction. When the government imposed the Corralito, the emergency restriction on bank withdrawals that froze deposits across the country, it was attempting to prevent a bank run. But the Corralito itself confirmed the fear that had been driving the potential run. Trust collapsed completely. The Argentine peso lost 3/4 of its value within months. Unemployment rose dramatically. Historical records document widespread social unrest, the resignation of multiple presidents within a single week, and a debt default that was, at the time, the largest in history. The financial crisis of 2008 demonstrated yet another version of trust breakdown, this time not among retail depositors, but among the institutions themselves. Documented history indicates that by the summer of 2008, banks had effectively stopped lending to each other. The interbank lending market, the invisible infrastructure through which banks manage their daily liquidity requirements, ceased almost completely. Banks that had been trusted counterparties for decades were suddenly viewed as potential sources of catastrophic loss. The reason was that no one knew, with any precision, how much exposure any given institution had to the collapsing US housing market. The opacity of the financial instruments that had been created over the previous 2 decades made it impossible to assess risk with confidence. In the absence of information, distrust filled the vacuum. The collapse of Lehman Brothers in September 2008 did not simply destroy one institution. It sent a signal throughout the entire global financial system that the assumptions underpinning that system, the assumptions about the reliability of counterparties, the safety of short-term money markets, the stability of the largest financial institutions, could no longer be taken for granted. What followed was the most severe financial crisis since the Great Depression. Economic data from the 2008 crisis suggests that global output contracted by more than 2% in 2009, the first global contraction since World War II. Unemployment rose sharply across the developed world. Credit contracted, businesses failed, pension funds lost value. And in a pattern documented extensively in the academic literature on financial crises, The costs were disproportionately borne by ordinary people rather than by the institutions whose risk-taking had created the crisis. To understand why these crises recur, it is necessary to ask a question that financial histories sometimes avoid. Who benefits from the system as it was structured? The answer requires an honest examination of incentives. In the decades before the 2008 crisis, the executives and traders of major financial institutions were compensated primarily through annual bonuses tied to short-term performance. A trader who generated large profits in 2005, 2006, and 2007 by taking on risks that would not materialize until 2008 was rewarded handsomely for the profits and suffered no personal financial consequence from the eventual collapse. The gains were private. The losses, when they came, were socialized through government bailouts and economic contraction that affected the broader population. This is what economists call moral hazard. When the people making risky decisions do not bear the full cost of those decisions going wrong, they will systematically take on more risk than is prudent. The structure of compensation in the financial industry, as documented extensively in the academic literature following 2008, created powerful incentives for exactly this kind of behavior. The regulatory agencies that were supposed to constrain this behavior operated within their own incentive structures. Historical records show that the period between the early 1980s and 2008 was characterized by a dominant intellectual consensus that financial markets were, if left alone, essentially self-correcting. This consensus, rooted in academic finance and widely adopted by regulatory bodies, led to a consistent preference for allowing financial innovation to proceed with minimal oversight. The people who built and sold increasingly complex financial instruments had strong incentives to do so. The regulators who might have constrained them had absorbed a framework that suggested restraint was both unnecessary and potentially counterproductive. The political economy of this era also deserves examination. The financial industry became one of the most significant sources of campaign contributions and lobbying expenditure in American politics and in many other developed democracies. Documented history indicates that this created structural pressures on legislators to maintain the regulatory environment that the industry preferred. The institutions that would eventually require bailout money had spent years and considerable sums working to ensure that the regulatory constraints on their activities remained limited. When trust in banks breaks, the losses are not distributed equally. Maria Fernandez, waiting in the dark outside her Buenos Aires bank in December 2001, represented millions of ordinary Argentines whose savings had not been used to fund speculative financial instruments. They had simply saved, over years of careful living, in the currency and the institutions their government had told them to trust. The Corralito and the subsequent devaluation of the peso wiped out the real value of those savings. Economic data from the years following the Argentine crisis suggests that poverty rates rose dramatically and that the economic contraction produced severe and lasting hardship for the working and middle classes of the country. In the United States, following 2008, the pattern was different in its details but similar in its structure. The government moved with considerable speed to stabilize the financial system through emergency lending facilities, asset purchases, and direct capital injections into major banks. Many of the largest institutions survived. Some of their executives continued to receive substantial compensation. But economic data from the years following the crisis shows that the recovery, while eventually real, was extremely uneven. Unemployment remained elevated for years. Homeowners who had taken out mortgages on properties, now worth less than the loan balances, were not rescued with anything approaching the speed or scale of the bank rescues. Pension funds that had invested in the financial instruments at the heart of the crisis saw their values decline significantly, affecting the retirement security of millions of workers who had made no financial decisions of any particular sophistication or recklessness. This asymmetry between who is protected when the system fails and who bears the residual costs is not a random outcome. It reflects the distribution of political and economic power within the system. The institutions that are most central to the functioning of the economy, the ones deemed too big to fail, are also the ones whose failure the government has the strongest incentive to prevent. The households and small businesses that are not too big to fail have no such protection. The question that follows naturally from this history is uncomfortable but necessary. Is the system meaningfully safer today than it was in 2007? The regulatory response to the 2008 crisis was substantial. In the United States, the Dodd-Frank Act of 2010 introduced significant new requirements for bank capitalization, stress testing, and the management of systemic risk. In Europe, new banking regulatory frameworks were established. The Basel III International Banking Standards, developed by the Bank for International Settlements, imposed higher capital requirements on banks globally. Economic data suggests that the largest banks are, by conventional measures of capitalization, more resilient today than they were in 2008. But the conditions that produce crises are not static. The extraordinary monetary policy of the years following 2008, with central banks in the United States, Europe, and Japan holding interest rates near zero and conducting large-scale asset purchases, created its own set of structural pressures. With safe assets offering minimal returns, investors were systematically pushed toward riskier assets in search of yield. Asset prices, including housing markets, equity markets, and private credit markets, rose to levels that required continued confidence and liquidity to sustain. The rapid rise in interest rates that began in 2022 in response to the surge in inflation that followed the economic disruptions of the global pandemic created new stresses within this environment. Historical records from 2023 show the failures of Silicon Valley Bank and several other regional American banks, failures driven in significant part by the dynamics of rising rates applied to portfolios that had been constructed during a period of very low rates. The pattern was familiar. Concentrated risk, insufficient attention to the scenario that eventually materialized, and a rapid deterioration in depositor confidence once the underlying problem became public. The larger question is not whether the next crisis has been prevented. Financial history suggests that crises cannot be eliminated from systems that are built on leverage, interconnection, and the fundamental requirement of confidence. The question is whether the structural features that amplify crises, the asymmetric incentives, the opacity of complex instruments, the political economy of regulation, have been addressed with sufficient seriousness to contain the next disruption when it inevitably arrives. There are no perfect solutions to the problem of trust in banking systems, but economic history does offer some guidance about what makes systems more resilient. Transparency matters. When participants in a financial system can assess with reasonable accuracy the risks being taken by the institutions they deal with, the sudden collapses of confidence that characterize acute crises are less likely. The opacity that characterized the structured finance products at the heart of the 2008 crisis was not an incidental feature. It was, in many cases, deliberately constructed because opacity is commercially valuable to the institutions selling complex instruments. Regulatory requirements that mandate genuine transparency impose costs on the industry but provide genuine systemic benefits. Incentive alignment matters. Documented history shows consistently that when the people making high-risk decisions bear a meaningful portion of the downside risk of those decisions, the volume of socially excessive risk-taking declines. This does not require eliminating profit motives from finance. It requires ensuring that the people whose decisions create systemic risk have skin in the game. The size and interconnection of financial institutions matters. Economic data from multiple crises supports the conclusion that institutions that are too large or too interconnected to fail safely represent a structural problem that cannot be solved purely through better regulation. When an institution's failure would threaten the broader system, the implicit guarantee of rescue distorts the incentive structure in ways that are very difficult to correct through oversight alone. And finally, the political economy of financial regulation matters enormously. Historical records show that regulatory systems tend to be most attentive to systemic risk in the aftermath of crises and least attentive in periods of extended stability. The challenge is to maintain adequate scrutiny of emerging risks during the long periods when the system appears to be functioning well, precisely because those are the periods during which the structural vulnerabilities of the next crisis are being built. Maria Fernandez is not a character in a textbook. She is a composite of millions of real human beings who have, at various moments in modern history, discovered the hard way that the institutions they trusted had been built on foundations more fragile than anyone had told them. The history of banking crises is not, at its core, a story about numbers or financial instruments or regulatory frameworks. It is a story about the relationship between human beings and the institutions that mediate their economic lives. That relationship requires trust to function. And trust, as this history repeatedly demonstrates, is not a passive condition. It is an active social achievement that requires constant maintenance and honest institutional behavior to sustain. Financial systems are among the most powerful inventions in human history. The ability to pool savings, extend credit across time and distance, and allocate capital toward productive uses has generated enormous wealth and lifted billions of people from poverty over the past 2 centuries. These are genuine achievements of enormous importance. But the same systems that create wealth also create the conditions for the destruction of wealth. The leverage that amplifies gains also amplifies losses. The interconnection that enables efficient capital allocation also enables the rapid transmission of financial shocks across institutions and borders. The trust that makes the system function also makes it vulnerable to sudden, non-linear collapses in confidence that no regulator can perfectly anticipate or prevent. Understanding these dynamics is not a specialist occupation reserved for economists and financial analysts. It is a form of civic literacy that is relevant to every person who holds a bank account, contributes to a pension, takes out a mortgage, or participates in any way in the economic life of their society. The people who are most harmed by financial crises are almost never the people who created them. They are the people who trusted the system without fully understanding how it worked. The most honest response to this recurring pattern is not cynicism about financial institutions or fatalism about the inevitability of crisis. It is the cultivation of a clear-eyed understanding of the mechanisms through which trust is built, maintained, and destroyed in financial systems. Because the next crisis, whatever form it takes, will be navigated more wisely by people who have studied the ones that came before. History does not repeat precisely, but it carries within it, for those willing to read carefully, the unmistakable patterns of human behavior applied to financial systems. Those patterns have much to teach.